I'm Scott Allen Miller. It is the 5th of January 2023 and welcome to my vlog of daily life in Leon, Nicaragua. Today, very little of a daily news update, so I'm going to do it real quick, and it's basically going to be a topical day, so I'm not going to split it today, even though it's pretty tempting to do so. So today is Thursday, and it's mostly a logistics day between having a lot of work for the office. It's still very busy just because lots of customer work coming in, and of course I've been off, and or not off, but traveling, and I had to do a lot of arranging because we're doing house showings tomorrow, and helping. I'm meeting a couple people over the weekend to help with relocation to Nicaragua, just discussions and stuff. And so I've got busy stuff coming up and things I have to coordinate today, and was pretty much in the office all day in the house because I work from home, and that's about it. So today, the topic that we're going to have, and we're going to go to it in just a second, is we're going to talk about insurance. And this is going to be kind of how it applies to travel, but also how it applies to life insurance and health insurance and house insurance and car insurance and homeowners and warranties on products and stuff. I think all of that is really important. We're going to do a little bit of a different format for that because there's so many items we have to hit. So that is going to be our topic for the day. So it's kind of a financial discussion, but it plays into, so it's very general, right? It applies to travelers because travelers ask me about this stuff, and it applies to non-travelers because there are some general financial and mathematical and statistical and risk analysis rules to insurance that everyone should know. Meaning this should be stuff that everybody teaches and everybody learns and everybody thinks about because these are general purpose rules, and it's one of those things that society really discourages people knowing about, much like general investing, because it is not in the interest of society that you do these things well, right? It's in the interest of society that you do investment poorly but still do it, and get insurance poorly but still do it, and go to university poorly but still do it. All those things hurt you if you don't do it right and benefit society in the way that they encourage you to do. So that's why there's this underpinning of don't do it well, do what we say. And so we're going to tackle a whole bunch of what you have to understand from a math and risk and logic standpoint with insurance, and understand what insurance is for, why it applies, when you should want it, and when you should want to avoid it. Because I think some general purpose rules, some background information, some math, and suddenly it's, oh, now it's a lot more clear. Still not going to help you with your copay deductibles and that stuff, but it'll give you a start at least. All right, before we do that, please remember, like and subscribe, and any questions, comments as you watch the video thing, get down there, down below, just scroll, you can comment, ask. Our conversations on here are decently lively and getting livelier every day. I really appreciate all that activity. One, just great to get to know you guys, and two, it does a lot to promote the channel. It gets things going, and YouTube loves it when that happens. It knows that we're getting engagement, but also hit that like button because that tells YouTube that it's positive engagement, and then get in the comments and make it more engagement. And of course, you can buy me a coffee. There's no income from YouTube. I know it seems that way, but there really isn't. So I make a total, on average, about $2.50 per day from YouTube. So if you want to actually support the channel in some way, buying me a coffee really does help. That link will be down there below and on the screen. And of course, share on social media like Facebook or Twitter if you still use that. Does that still exist? I don't know. And on Instagram or wherever, just get out there and tell people about it. We post on YouTube and Rumble as best we can, and try to get the word out there. So anything you can do to tell people about the show, boy, does that help. And by the time you're seeing this, we should be over 2,200 subscribers, which is fantastic. We got quite a few on the day that I'm recording. All right, that's it. Let's head off and discuss the underpinnings of insurance and warranties. Let's go. All right, so let's start with a little history of insurance. Now, I'm not an insurance historian, but I do play one on YouTube, and I'm going to do my best to get the story correct. I have not heard the story in many years, but this should be roughly accurate. Modern insurance started from a group of shipping companies in like the 15 or 1600s when there was a lot of international shipping. This is on big wind-powered boats, right, going between Europe and the New World. And at that time, a lot of them were coming out of England, and the risks of ships were pretty high. And the problem was that the loss of an individual ship with its cargo would be so potentially destructive that a single shipping company could very rarely shoulder that cost on their own. And so because it was so dramatic, but because the overall risk was bearable, what they were able to do was a group of shipping companies, probably not the largest ones, I'm just hypothesizing, but mid-sized ones, who were able to put enough money together to have a ship or two or maybe three, but could not likely withstand losing one of them, or was fearful that someone would lose none and they would lose two, got together at a coffee house in London, talked about it, and decided to pool their recovery resources and to protect each other so that one of them being unlucky would not affect those that were, or would be, the risk would be shared amongst the group, so that a single one of them being unlucky would not go out of business just because they got unlucky. Rather, the entire group would simply manage risk as a whole. That coffee shop is Lloyd's, and Lloyd's of London is called that today because that is the coffee shop in the place where those people originally got together and invented modern insurance. That was very important for a couple reasons. It worked, right? It worked because it was shared risk. The people who were pooling their resources, the people who were protecting themselves, were also the people running the risk pool. There wasn't an additional group creating overhead. Of course, there was a tiny bit of overhead. Someone had to take the time to manage the books. Someone had to monitor to make sure people weren't scuttling their ships to try to collect insurance money. But early on, it was just about this really simple protection among a group of people who knew each other. It was very effective. And the risk was not something they could bear on their own. It was that it allowed them to make an investment so large that it was so much exposure that it was worth sharing risk with other people in order to protect against natural disasters, pirates, and things that they couldn't reasonably protect against. It required a few things. It required a lot of trust. These different shipping companies had to trust that they were all going to do their best job to avoid pirates. They were all going to do their best job not to let their ships sink. They were all going to maintain their ships and things like that. But after doing all those things right, for most of them, if they were to lose a ship or simply get a little bit unlucky, they would go out of business, and that didn't help anybody, right? The shipping industry could handle more ships. They weren't putting each other at risk by supporting each other, and so by working as a group, they benefited. The shared risk concept is fundamental to what made insurance a valuable proposition from day one. So that brings us to today. When we're talking about insurance for you, whether it's your business or personal, we have to consider a lot of factors. And one of them is, why do you have insurance in the first place? To do insurance correctly, to have it make sense, it must be an item that you can't bear on your own. And so this is where a lot of people get mistaken with insurance. They think that it's going to make sense to have insurance on something that they could easily replace. I'm going to insure my microwave, for example. Well, for the average person, for nearly all people, the breaking of your microwave is not a tragic experience. It's something that you could shoulder the burden alone. If you were to lose your microwave suddenly without any warning, suddenly your microwave just broke. You can't make your Stouffer's dinner tonight. What are you going to do? Well, you're going to run to Walmart, you're going to buy another one, and you're not going to think very much of it, right? That is not a good item to insure because it doesn't meet the qualification of an overwhelming burden. And we'll talk a little bit about why you need that overwhelming burden. And it's simply because of overhead. But so throughout your life, you self-insure. Basically, everything in your life that you don't carry insurance on is something that you self-insure. And the way that humans self-insure is that we buy many things or don't buy many things, right? We have many items we could potentially insure throughout our lives. It could be your shoes, your microwave, the front door, the door locks, and we simply replace them when they break. And sometimes we fix them when they break, and sometimes we do without them when they break. And in these cases, we are providing our own mechanism of insurance by putting up the money, having enough money of our own, and replacing them, right? It's not a hard concept, and you do this for small items every day. And so things like the microwave, you can easily replace. You don't want to, it's still a waste of money, you're still losing money, and you think, well, what if I was insured about that on that item? Well, I wouldn't have to pay to replace it, it would just get replaced. So why does that not make sense? The number one problem with insurance is that today is that the concept of shared risk is effectively gone. Today, when we're talking about insurance, we're not talking about shared risk in the same way where there's a group of people, they all have roughly equal risk, and they're all willing to insure each other based on a mutual need. Instead, we buy insurance individually, and we don't know what our risk pool is. There is a risk pool for sure, but we are insured by a company, and that company is a for-profit entity, or even worse, I suppose, a non-profit entity that is making money off of the process of insurance. And in normal cases, for all reasonable cases, you're talking about a company that's making a lot of profits off of this process. Now, if you went to Lloyd's of London hundreds of years ago and said, okay, so all of you shipbuilders, shipping companies, you're going to share this risk, but in order to share this risk, you're going to pay this astronomical amount for that risk abatement. And you say, wait, so if we just share a risk, that's one thing, right? On average, I'm going to break even. If everyone was doing what they were supposed to do, everyone was maintaining their ships the same, everyone was taking safe shipping lanes the same, and it was just, sometimes you get unlucky with weather, sometimes you get unlucky with pirates, sometimes bad things happen, and you're simply attempting to counter luck, then the shared risk pool can make sense and risk is pretty straightforward. But the moment that there's overhead of any measurable amount to that risk pool, where the risk pool itself is making money, then you have a real problem, because you're no longer looking at just sharing risk. You're now putting in money to try to offset the risks rather than extra money. And that extra money you put in is risk itself. Only with the risk pool, the original shared risk concept, on average, everyone broke even. Now, there were winners and losers. Someone lost a ship and got it replaced and didn't have to pay for it, and someone else didn't lose a ship and did have to pay for it. But that's it. From a risk perspective, the entire pool was just even. Everyone put in the same amount of money, the amount of money went out, and the risk was just abated as best as possible. There was no guaranteed loss. In modern insurance, it's a guaranteed loss. The people in the pool are going to lose on average, and lose big on average. Those really important concepts that now we have a guaranteed loss by the pool. Yes, there's still winners and losers, but instead of being on average, everyone breaks even, we now have vastly on average, you lose. And so it's more like playing the lottery now, that you're getting insurance, but you're hoping that terrible things happen to you and that you get protected from it, because that is the only situation in which you don't lose dramatically. And that's a really big deal. That across the board, originally that insurance only made sense because it was a non-overhead risk pool, and it was an amount of money you could not live without. Right? You could not replace that ship. You could not make do. You couldn't tighten your belt and make it through. You would have gone out of business. It would have been disastrous. So that insurance was critical. For most things today, we don't have those problems, right? We don't have the ability to have a shared risk pool like that, not in general, and we don't have that many things in our lives that most people can't afford to lose. It may seem that way. You say, well, I couldn't afford to lose my car, I couldn't afford to lose my house, but most people can. And that's really important, that those concepts be separated, right? The degree to which you may owe money on a house, yes, losing that house would be absolutely tragic for anybody, right? But the degree to which losing that house would be tragic compared to losing a ship is probably not comparable. It would be more like if you had leveraged family financial resources and bought dozens of houses and they all disappeared together in a single event. That is what they were insuring against. The cost of a ship was so astronomical, it would be, in today's terms, tens or hundreds of millions of dollars that businesses had managed to raise over generations and probably leveraged a lot of debt to be able to have. And it would not just be, oh, they can't replace their ship, they wouldn't have a place to live. It would be this really dramatic, they would cripple entire families for generations and send the industry into a spiral and cause the country to lose the capacity to keep shipping. There was a lot of big problems that came with this, as the financial disaster was epic, whereas most things that we're talking about insuring against today, even the biggest ones like houses and cars, are really trivial by comparison. And that's really important as a starting point, that how it's completely different than the concepts that made insurance something you would even consider in the early days, and what made them invent the concept as a financial instrument. So that can't be overstated. And that overhead, that huge profit, that guaranteed loss to the pool means that in general, we should all be wanting to avoid insurance at all costs, because it is just taking critical financial resources that we have and moving them to someone with no interest in protecting us and no interest in us, someone who is effectively an enemy company, a hostile entity, and not only giving them on average a whole bunch of our money, but giving them control of money when they are a hostile entity. The original pool was a group of friends, a group of people who worked together and knew each other. They didn't really want to screw each other over. They may have wanted to make money, but they didn't want to screw each other over. But modern insurance makes its money by not paying out. And so so they have a huge overhead and they don't want to pay out. There's a lot of adversarial and they have very little opportunity to figure out. You have a desire to get them to pay things that you don't need, right? So it's not like it was very discreet in the early days. And now it's like, well, how much stuff did you have in your house that you insured? Well, it becomes a very, very difficult thing, right? Oh, you had a car accident? Yeah, and I was carrying eggs in the car, and eggs are now $5 an egg, and I had 300 dozen of them in the car. So I need quite a bit of money. Right? Why does the person who's carrying fragile things in their car get more money than the person who carefully didn't put those things in a car? Why would the pool have to pay for one person? It's very much just make up the system is broken, and it's broken because the more broken it is, the more it favors the insurance companies and the less it favors the insured. And so it's not going to change because insurance companies have lots of money to make by pressuring you to get insurance so that their overhead can make them rich. All right, on to our next item. Okay, so beyond the basics that insurance is not a sensible concept for normal things, that the entire reason you would get insurance doesn't apply to normal people, now let's talk about all the things that go wrong when we start using it when we shouldn't. One big one is that the cost of everything that insurance does goes up. And this is mostly for reasons of corruption, but it happens for other reasons too. Typically, when you're dealing with insurance, if you want to get something, it doesn't matter, house, car, health, it doesn't matter. If they know that insurance is going to be paying, you have a bunch of things that happen. One is that the insurance company is likely to pay kind of blindly and may or may not pay, right? The biggest problem is they will simply decline payment in many cases and either leave you on the hook for paying for something you didn't agree to, or simply leaving you without the thing being replaced. And then, yes, sir, certainly you can go argue that, but insurance companies have deep pockets and they know when they're likely to win. Just because something bad happened to you, just because you paid for insurance that should have covered you, does not mean you're going to be covered. There's a lot of contractual and legalese, contractual limitations. So there's a lot of cases where you may think you should have been paid and you legally should not have been. You did not actually have insurance for the things that you thought. And in a lot of cases, it is ambiguous. Oh, acts of God, right? Well, to some people, everything's an act of God. To some people, nothing's an act of God. It is purely up to a court at the time to decide who has to pay for what. Having insurance for only some things, but not things as we determine after the fact is very problematic. So in a lot of cases, you simply don't get paid. And that alone makes it almost insane to consider. Even if it was only 1% of the time, that's enough to make it so risky for insurance you would not consider it. But then, even if they do pay, quite often the cost of things that they pay for are not that good. So let's say you're getting a car repaired. Well, if you were to get a car repaired on your own, chances are you know someone you can take it to who will give you a fair deal, someone you've worked with a number of times in the past. You can simply shop around, whatever. You may fix it yourself. In all those cases, you're probably going to get a far better deal than the insurance company would give you. So let's say you've paid $10,000 into the insurance company over a period of time, and then you have an accident with your car and it's valued at about $10,000 to get it fixed in the shop. Maybe they'll pay the $10,000. Let's just say that they pay and there's no problem. There's a real possibility that you may have been able to gotten that car repaired for far less than $10,000. You may have been completely okay with a third-party part or a used part, or have done the work yourself and made the whole thing cost $5,000 or $2,000. Or maybe you would have said, you know what, I didn't need that car. The fact that it got destroyed is inconvenient and unfortunate, but I don't actually care. And I'm going to pocket that $10,000 that I would have paid into the insurance, and I don't need it. So there's a lot of cases, a ton of cases, where it doesn't make sense because the amount that an insurance company would end up paying out is far more than the amount you would have ended up paying out. And that means you have to pay twice as much to the insurance company as you would have had to have paid to fix it yourself without the insurance company. And that's generally the case. It is very rare that an insurance company is going to get a really good rate. And partially that is how they make the insurance look better than it is, because they pay big amounts out and they make it scary for you. You say, oh my gosh, I could not have paid $10,000. That was so expensive. But you wouldn't have had to have in many cases. You could have paid $5,000 and been completely happy. And so those numbers are very important to understand. And that's in cars, it happens a little bit because you have to go to an approved vendor for the insurance company. You can't just go to whoever is affordable or whoever you trust. Sometimes you have to travel to other cities. Sometimes you have to give up your car for long periods of time. A lot of potentially bad things happen that make the cost, whether it's the hard cost or just the cost to you, go way up with insurance, and you have the flexibility to abate those things when you insure yourself. Another major problem that you can get into with insurance is they may not offer the services that you want. Now, this is less likely with your car, but certainly possible, a little bit more likely with your home, and much more likely with your health. You may end up in a situation where you want a certain level of care, and it's important to you, especially if it's your health, that you're not willing to compromise and say, go to a doctor you don't trust. And this is something that happened to me personally. I was forced to either relinquish health care from not just from my insurer, but in total, or do something that was very, very risky and violated general basic good health practices. And because of the way the insurance company worked and the way that the state health system worked, the insurance company was able to limit what we were able to do and put this really big risk in place, so that we had to choose between taking on one type of risk or another, even though there were good, healthy options that were simply not provided. For a lot of people, for example, in the United States, you may be limited to, let's say, cancer care. You choose you go to a doctor, they give you some options. You may talk to another doctor and they say, well, there's a lot of other options, but they require, say, leaving the country. And for a lot of people, if you were paying for your own health insurance, you may very quickly, or you were self-insuring, you may very quickly say, oh, wow, I can get better care or highly recommended care somewhere else that may save my life, but the US doesn't offer this procedure. Maybe it's not approved. Maybe it just isn't well known. In some cases, maybe it doesn't make enough money, right? And that's a real problem in many cases, is that there's cheaper options somewhere and they don't offer that in the United States because it's not profitable enough. If it was your own money, if you had control, even if the money didn't matter, you would choose that healthcare. You would say, I will go wherever it takes to get that quality healthcare, and that's not a big deal. Also, in most cases, that additional healthcare would be much cheaper, right? The local healthcare controlled by the insurance is going to be overpriced, and it's easy for the insurance company to then negotiate a deal on the back end that you never see, or get a kickback, or any number of things to make it that they are becoming profitable, even though the cost of the healthcare is astronomically high compared to what it actually should be. If you are paying out of pocket, in many cases, your health, even in the United States, your healthcare will be a fraction of the cost. You can go in and negotiate ahead of time. You can't do that with insurance. You can't negotiate at all. The insurance negotiates for whatever rate they want and then determines if they're going to pay it or not. But if you're paying yourself, you simply negotiate a price, you pay it, you have far more control, you're able to get much deeper discounts, and when someone else, someone in Mexico, someone in Colombia, someone in Switzerland, offers care that's cheaper, better, different, whatever, you have the option of taking it. That lack of options is a really big deal when you're working with insurance companies. You are going to be limited to who they approve. Now, some insurance companies will approve a lot of different people, some will approve very few. That depends on the situation, but in general, you're going to bring on enormous limitations that put you at very great risk. And it doesn't matter if it's your car. Maybe you have a classic car and the only person who really knows how to fix it to your satisfaction is in Japan. Well, if it was your own money, you would ship it to Japan, get it fixed, and ship it back. But your insurance company is going to say, no, getting it fixed at your local shop is perfectly adequate. They're certified and whatever, and it's going to drive safely, and they're probably right? But maybe you wanted it to factory showcase condition, and your insurance company says, no, that's not how your insurance works. And now you're stuck with either not getting insurance or getting something that makes you unhappy because it did not meet your personal needs, and you've spent money on that is now lost. That flexibility is another really key piece. When we were dealing with, again, the original insurers at Lloyd's of London, when there was just a group of people, they could do anything they wanted, right? It wasn't limited to simply being, this third party hands-off interaction. It was people sitting around a room and very practical. That loss of practicality really makes the insurance system today difficult. Using insurance puts someone else in charge of your medical care, home repairs, whatever that item is. It takes the control out of your hands and gives it to someone else. If it's something simple, like you bought a hard drive at the local store and they give you an insurance plan, right? We call them warranties, but warranties are just a form of insurance. They give you this warranty plan and they say, oh, you pay this, say $5 on a $100 item, and they know that 1 out of 40 people are going to actually take them up on it. And of course, there's the risk that you simply lose your policy, or you forget about your policy, or your policy times out before the thing fails, right? They know there's all these strategies that make it seem like you're getting a good deal of protection, but in actuality, statistically, you're paying for something that you'll essentially never be able to use, whether you could have used it and it's your fault, because they know a certain number of people, 90%, lose that stuff past the first week or two. And of course, if it failed, what they don't remind you of is if it fails, immediately as you get it out home from the store, it never worked and you don't have to pay for it anyway. Take it right back, get your money back. The times that things fail after you could have gotten your money back anyway, but you still have the paperwork and you still know where to take it back to. And what if that store doesn't exist anymore? What if that insurer doesn't exist anymore? Those companies go out of business. Every time they go out of business, everybody insured with them loses, right? And it can be any number of things. There's entire ways to create, holding companies to allow those companies to evaporate and create a new one, and not have to move that responsibility around. There's a lot of ways to make sure insurance companies don't have to pay out when if they're making a ton of profit, they'll just keep doing it. And if they are at risk of losing that profit, they'll just declare bankruptcy or shut down the business or whatever and move on. They have ways to make sure they are not really at risk. And that actually brings up a really important point. Not just are you giving up your control. I need to mention why that's important. If it's healthcare, you're putting someone else in charge of your healthcare, right? You're saying, I don't have the money to pay for it, so here's what money I have. You now control my health. You decide when I'm not worth saving. You decide when my leg is worth amputating or not. You decide whether or not I get that heart disease medication I need. Someone on a financial calculation with no interest in your health and no value from your health is going to make a decision about your health. That's a terrifying scenario, and nobody should ever be put in that position, right? This is insurance for something like health is so bad. It's unthinkable how bad it is, given that it's not a shared risk system. There is a shared risk system for that. It's called nationalized healthcare, and that is why there are countries, the only people who share an interest in your health is the people in your country, because their overall economy benefits best from a healthy populace. And so while an individual, you may be like, oh, I don't know if they're worth saving, having good healthcare for the entire populace actually benefits the entire populace financially. You actually make money from that. And so there is a system for that, but it is not insurance, right? And it has to be everybody, right? It's the only way that it works. With the hard drive idea, right? Yes, you bought it. Maybe you got 2 years of use out of it. Maybe it has met its need, but you have this warranty. Now, if it breaks, yes, you could get it replaced, but do you need it replaced? Sure, you spent, say, $100 on the drive and then $5 on the warranty replacement. You're like, well, I paid for the warranty replacement. I'm going to go get it. But is it just going to sit on your shelf? If that's true, then in that scenario, you paid $105 instead of $100, and it didn't give you any extra value. You may feel emotionally good about it. Well, it's still on the shelf, but I didn't need it anymore. I used it for the first year, and now I don't have a need for it. That ability to just no longer need something, it doesn't matter. You already spent the money to replace it, so you're kind of stuck, even though you don't have a use for it. Sure, you could sell it, but are you going to? And you could have sold it before, right? And so it may sound like very little, but it's only $5. It's not. Right? If this is a pattern you're going to follow, it's $5 on everything. It's $5 on the microwave, $5 on the hard drive, $5 on the memory stick, and over time, it's many, many, many items you could have purchased, but instead you bought warranties. And mathematically, it doesn't matter how often you do it, right? It's a common mental, emotional trick that companies play on us, that we play on ourselves, that we say, well, adding 5% of the cost to an item, it makes me feel good that I have this protection. Yes, it does make you feel good. It's an emotional ploy. Financially, it makes no sense. Logically, it makes no sense, because you have to look at, is it a 5% chance? Is it protecting you on average by 5%? No, it can't possibly, right? It is protecting you. Now, warranties do have a theoretical ability. A company that really wanted to do a good job with warranties could come up with a warranty that benefited everyone in theory, but it's extremely difficult to do so. The margins on that are very small, and they wouldn't bother because they wouldn't really make money when they can make a lot of money through giving you a warranty. That doesn't make sense. It just doesn't add up. But in theory, you could make a case for where it could happen. I'm not saying that in that particular case it's physically impossible, but it's essentially impossible. But in other cases, like houses, we can say, well, if I self-insure on a house and it burns down in the first year, what am I going to do? I can't afford to cover the house. I'll be stuck paying it for the rest of my life. Well, there's two things that insurance doesn't account for. It's the walkaway and bankruptcy scenarios. And that sounds terrible, but there are many times, like the hard drive, you may just want to walk away. I don't need to replace it. That wouldn't have cost me any money. I was done using it. So it's worthless to me. It's a good thing I didn't insure it. Every penny of insurance would have been lost. And in a house scenario or something else that's really big, yes, it's unfortunate, but there are times and mechanisms already existing in most countries to protect you against truly catastrophic loss. And yes, you're going to take some pain, but not as much as insurance would have been, and not as much as trying to pay it for the rest of your life. And that is some mechanism similar to declaring bankruptcy. Okay, you completely lost your house. That's really unfortunate. You took a risk that made sense and you still lost. It's going to happen sometimes, right? But if we are insuring, we put in all this money. Yes, the insurance would have protected us, but on average, we would have lost a ton. But if you have that disaster right at the beginning and you haven't paid in, it's hard to explain all the math. But if it happens right at the beginning, you have that option of bankruptcy, right? Well, I didn't put very much money in. I'm not actually invested that much. It's best to just burn it all down and move on. And yeah, it's not a great scenario, but it's not a bad scenario. People who understand financials do this all the time. Bankruptcy is a valid but unfortunate financial instrument that you need to consider and weigh against things like throwing away far more money with insurance. Now let's talk about house insurance, homeowners insurance, because this is really important mathematically how this works. Now I'm just going to throw out some very average numbers, and you can go calculate your own scenario in any way you want. But when you're doing anything like this, you have to keep in mind that insurance is just a form of investment vehicle. Right? Everything having to do with money, even when it's really far at arm's length, it's always a risk strategy and an investment vehicle. And you have to look at it that way and weigh against alternative options. If you don't, you're going to get burned. And that's what insurance companies count on, is you not evaluating it with its risk. They want you to feel it's risky and feel that the word insurance makes it less risky. And they want you to not think of it as an investment vehicle. They want you to think of it as protection. And that is exactly how bonds take advantage of people. That is exactly how just every con artist trying to make quick financial money gets you, right? And the older you are, unfortunately, the more likely you are to have the money to put into it, and the more likely you are to fall for it. And so it's really important that as we become an older population, just the people who watch my channel as you get older, that we become more wary of these things, because their benefits, they are more and more likely. When you watch ads on TV, right, who do they target with insurance scams? Those who are middle-aged and older, right? They don't go after kids. Kids are very wary of insurance. Naturally. Well, it seems like I could just live without that thing. I could just pay for it. Why would I have insurance? Right? You have to make people panic. You have to make them feel like they need insurance, and that takes a lot of marketing and deception over time. And as people age, just naturally you become more susceptible, right? People who fall for phishing scams and emails are likely to be over 40. I'm over 40, so that I'm in that pool, right? We're far more likely to feel compelled to open an email that's obviously a scam than someone who's 20. It's just nature. When you're young, you're more wary. You understand that the world is full of scammers, and as you get older, you tend to trust strangers more, and they are far more likely to prey on you because of that. They target people who are getting older specifically because they make bad financial decisions and start to worry that the careful math they did when they were young is not going to pan out. And then they use the example of other people for whom also panicked, also burned down their math from when they were young, and then had disaster, and then use that as an example of how the careful planning when they were young didn't work. because they abandon it, but they ignore the fact that they abandon it and then copy the disaster and use it again and again and again as an example of what to do, even though it was exactly the thing of what not to do in that moment. And they should have evaluated it, but people don't. That's just not how people work. So let's look at a homeowner's insurance example. And I'm going to throw a bunch of things like average out there. We'll see if that's true. So I'm going to say an average house in the United States is about $200,000. And I'm going to say that the average insurance on that house is about $100 per month or $1,200 per year. These work out to be really handy numbers over the long haul. All right, so if you're going to own a house for about 40 years, and remember, when you're dealing with insurance and financial things like this, it doesn't matter how long you actually own the house. Averages are what matter, not how long you will actually own the house, because the insurance or the interest or the whatevers work on a minute-by-minute basis. We just look at them over large lifetime numbers to know how the minute-by-minute works, but you cannot be misled by that. It does not matter. Oh, well, I'm going to sell my house in 2 years. Has nothing to do with it. In no way is that a factor. Okay? This is purely math, and we use these averages to understand that if you were only going to own a house or have a living situation for 5 years throughout your lifetime, that would affect us. But as long as you're going to have a large number, it doesn't matter how many houses it is, you're going to pay insurance on each one. You're going to up the rate when you go to a bigger one, whatever. It all floats together. So it's trust me, the math is solid on this. So if you have an average size house and an average size payment, right? And of course, if you have a cheaper house, you have a cheaper payment. If you have a more expensive house, you have a more expensive payment. It all tracks together. This makes it easy. Over about 40 years, the amount that you're going to pay into the insurance, on average, for the average person, is roughly the price of purchasing the house in cash yourself. Now, that's based on the obvious baseline of what do you do with the same money. Well, in one case, you're putting $100 into an insurance company. In the other case, you're putting $100 into an index fund, right? And so this is based on very conservative average rates of return. And that is always how you do a financial calculation. If you don't understand that, go watch my videos about like index funds and stuff, how to understand baselines. If you compare against anything else, it is intentionally misleading to make insurance look better than it is. Don't let anyone show you money in some other context. This is what a baseline alternative to insurance looks like. If you were to do that, put $100 a month into an index fund, after 40 years, which is a low number for lifetime housing ownership, you would have more money sitting in your bank account than it took to purchase that house initially. And people may say, well, what about inflation? All this tracks inflation as well. So you can ignore inflation. The numbers stay stable. So now, after 40 years, you have the ability to buy another house. Now let's ask people who have had insurance, what is the chances that from having insurance, you are going to have spent the amount of money to completely replace your house during the last 40 years on things, this is important, that insurance would have covered? I know almost no people who have ever been covered by homeowners insurance. Almost no one. Everyone says, well, you should have had insurance for that. But when you call your insurance company and say, would this be covered? They say, what are you talking? Of course that's not covered, right? If your roof is brand new and it fails in the first 6 months, the roofer covers it. If your roof is brand new but fails in the first 3 years, yes, maybe insurance covers it. If your roof fails after 8 years, they say, no, we don't cover that, right? Roofs get old. We can't cover things that are old. You have to be new. It didn't fail, it's just wore out, right? And I've had a lot of conversations with insurance companies about this over the years, my insurance that I pay for. And in every case, the thing that everyone says, well, if you had insurance, it would pay for it. When you call, they say, no, that is not how homeowners insurance works. If the place caught on fire and burnt to the ground, absolutely they would replace it, but not for these other things. And if it floods, which is a common thing, nope, not covered, right? If it was an unforeseen incident, if it was an act of God, nope, they don't cover that. Well, what do I need insurance for if not for acts of God? That's what insurance would be for in everyone's mind, except the insurance companies have said, no, not those things. I don't even know what how is fire not an act of God, right? Well, it probably is, depending on how the fire starts. So they have to investigate that, which is costly, and there's no winning, right? The math is so not in your favor. It makes no sense to have this insurance. So on average, you're going to, every 40 years, buy your house again. And so basically, it's not quite as bad as taking out a second mortgage in most cases, but it's basically like carrying two mortgages that at the end, you could have had another house. Now, don't go out and buy another house, right? Put that money into an index fund, save up that money. Have enough money to rebuild your house just like that if you want. If something was to happen at the end, well, just go build another house. You've now had that money all that time. You had that safety, you've had that comfort, and you just build the house. And you say, well, that's unfortunate. I lost my house, but I was able to replace it. I broke even, right? And I don't have to fight with the insurance company about it. I can rebuild anything I want, do it the way, maybe I can build it myself and save money, whatever. But on the 99% chance that your house didn't get completely destroyed during those 40 years, yeah, maybe you had to spend a little bit of that money to do some big repair somewhere that would have been covered by insurance, maybe. But if not, you have all of that money, and if you do, you have most of that money there to do something fun with, right? Maybe you just leave it for retirement. If you bought a house at 25 years old, which is about when I did, at 65, you're ready to retire. Now you have enough money in the bank to buy a new house, the same as your original house, in cash, that you can do anything you want with it. And then importantly, you can do nothing with it, and it's just this huge amount of retirement that's gonna help you. Or you can go just buy a house with it, or you can use that amount of cash sitting in a bank account to go to a bank and say, I would like a really competitive mortgage, because not only have I paid a mortgage on my first house and shown that I will do it and I'm good with that, I now have cash in hand to buy the second house. I don't need extra insurance. I don't need anything. You can prove all these things and get a better rate, get a better deal. Trust me, I've done this. I have the money in the bank account to pay for my house. When you go to buy a house and you say, I want a really good rate, and they say, I don't know if we can trust you. You show them a bank account that you could pay for the house in cash at any moment if you need to. They give you a really good deal. There's nothing safer. What collateral do you have? A bank account that could write a check to cover any losses? Done, right? That is a benefit in life that is hard to overstate. And at any point, now, this is where we talk about the bankruptcy strategies. If you have any reasonable amount of damage to your house over many, many, many years, you will have cash in hand to deal with it and you'll protect yourself. If you're that super unlucky person who has a complete disaster really early on, you have a couple choices. One is the bankruptcy. Just walk away and be like, oh, I lost some money. But on average, everything's a risk, right? If you don't have that happen, for most people, you get to the end of 40 years and go, I lost my second house. But they don't realize they lost their second house because they never do that comparison to see how much money actually got sucked out of their lives in order to do this. But everyone I know, by the time they get to retirement age, has put so much into insurance, gotten so little out of it, that they literally threw away an entire second house or an entire retirement that you could have passed on to your children or whatever. All these things, all this huge life power, the ability to go buy a couple Ferraris if you felt like it in cash, right? You can't do that anymore. You can't invest in something. You can't go start that business you always wanted to start because the money you could have had sitting in a bank account, you threw away at an insurance company who's never going to pay out. So yes, there's always risk, but the number of people who will get burned by not insuring is tiny. And the number of people who get burned by insuring is essentially everyone. And when doing that, it's math. It's all just math. And because of the overhead, there's all but no way for insurance to make sense until it's something you absolutely could not recover from. And that's almost nothing. There are very, very few things that are like that. Generally, we're only in positions that feel like that because of the insurance itself. Of course, we always have a fear that something tragic will happen and we'll be unable to continue paying insurance, and we may lose coverage during a tragic event, whether it be a loss of a house, a car accident that puts us out of work, or a medical condition that requires a lot of treatment and we're no longer able to work. We easily can lose medical coverage, and that is or any type of coverage, and that is really, really bad because we're in a position where we're unable to fight it. And the thing that we've been paying for, the protection that we're paying for, often evaporates upon the need for using it. And the idea is that you pay for a year or 10 years or 50 years, and then that insurance is there to protect you. But the problem is that at the time that tragic events happen, things that would trigger you to need insurance often trigger the loss of that insurance, and suddenly decades of your financial resources being tied up, being given to an insurer in good faith, evaporate, and you are no longer a customer. They don't know who you are, and that's it. End of story. Good luck being financially strapped, having your life devastated, and being able to sue the insurance company. There are exceptions to all this. Having insurance on liability that you may cause damage to other people, that's a very different thing, and that's often needed, especially when you're in cars and stuff, because we need the public to be protected against random people on the street. That is different. That is a public insurance, and it's because it's required by law of everyone, that works differently. Everyone has to do it. There's still terrible overhead to it. It should be going to the government, not to private companies, because it is a tax. By every definition, anything that the government requires of you, that becomes a tax financially, and that private companies are collecting tax creates a mismanagement of it. There's all this overhead that shouldn't exist. It isn't for the public good. Excess doesn't go to the public good, and so forth. But it is at least a public tax, not an insurance item. So look at it as you will. Now, last thing, and this applies more to businesses than to, say, homeowners or health insurance, but it still exists in the personal realm, and this video is for everybody, but and all the concepts cross over, but especially when you're dealing with things like errors and emissions or cybersecurity insurance. A lot of businesses carry these, and a lot of companies push for them, and these do something that are really dangerous. Now, homeowners insurance still does this, even health insurance does this, but these do it a lot, and that is makes you a target. If you have no money in the bank, or you have the ability to declare bankruptcy and walk away, the desire for someone to target you to get your insurance money is low. But if you have insurance that could pay out a lot, if it's health insurance, this is going to encourage a doctor to make up a disease that you have, or to give you some damage. Oh, we were doing heart surgery, we accidentally did some damage to your kidney, we're gonna have to do this $10 million procedure. We think your insurance company will pay for it. It doesn't matter if they will pay for it. If they think they will pay for it, they may put your health at risk. And this is saying a lot, but having dealt with healthcare in the United States, it is without a doubt on the table that doctors and especially hospitals will consider doing things that put you in terrible risk if they believe they can milk your insurance company for more money. They would absolutely do that. Not every doctor by any stretch, but it only takes 1% of doctors doing that for it to be an epidemic of tragic proportions. And that's what we see in America. Constantly people having to have procedures that other countries say, why would you do that? They did an investigation not that long ago. There's an entire category of knee surgeries that have been proven to not help, but cause a little damage. And they're done commonly in the US because insurance companies will pay for it. Doctors can damage your knee, get a basically guaranteed $30,000 payoff. And that's a lot of money to turn down for something no one can catch, right? But errors and omissions, same kind of thing. It makes people want to sue you because, well, it's not hurting them, it's hurting their insurance company. We all hate insurance companies for good reason, right? But now you're a target, but your insurance company has a very low chance of paying out. Well, people figure that's on you. You got a bad insurance company, you got a bad plan, you have a bad lawyer, that's your fault, right? It's your insurance company who's supposed to be paying. Hold them to it. We're going to come after you for things that aren't reasonable. Right? Or worse, cybersecurity insurance, we're actually going to get you to do something that's borderline illegal or sometimes completely illegal, definitely not recommended by the FBI. We're going to ransomware you, and we believe you have insurance. Doesn't matter if you have it, just if we believe you do, we're going to go after you for that insurance and hope that they pay out. So instead of asking you for $300, which you would probably pay, we're going to ask you for $3,000, $30,000, something big, right? Because your insurance company probably is going to pay it, because that's what they do. And the FBI says, don't pay that, right? But the insurance companies, they may be caught. Either they're going to not pay it and you're stuck with a much inflated number because they gave the impression that there was money behind you, or they do pay it because they get stuck with their contract and they have to. Then they may be breaking the law on your behalf to the FBI and funneling money to a terrorist organization or to just a criminal, right? Which is sometimes absolutely illegal and sometimes gray area. It is always frowned upon, and yet companies do it every day, and insurance companies do it every day. Insurance has become a mechanism for funding terrorism all over the world because of ransomware and the way that they pay these things out. So in a very hard line context, many insurance companies are truly mechanisms for funding terrorism. Like these are often not just companies that hate you as an individual and put you and your business at incredible risk because they want to make a quick buck. They're willing to put your country and your lives at risk to make a bigger buck. Right? It's a bad industry for the most part across the board. But these things are huge. Companies that carry insurance on normal business activities that should not be insured against very, very often become high-profile targets, And those companies often then do very little to protect themselves because what do they care? The cost is going to go to the insurance company, not them, or at least they believe that. And so why would they take an effort to protect themselves? Which means anyone who's in a risk pool with them is not only getting screwed by the overhead of the risk pool, but by the bad behavior of the other members in the risk pool, which completely violates all the concepts of the original Lloyd's of London risk pool, risk sharing, where everyone was doing their best to not let their ships go down, not be taken by pirates. They made more money by successful trips than by getting the insurance payout, but now that is often not the case. There's far more money to be made by having the insurance and not hiring IT or security or not bothering to do a good job, because those things require thought and effort, and just getting insurance is simple. And when people ask, did you do a good job with IT? You just lie, no one knows. When you have insurance, you can prove it or not. And so you say, yes, we have insurance. So making yourselves targets is a really big deal. At the end of the day, insurance mathematically can't make sense, right? There are extremely unique situations where it can, but they are very, very rare. But it is a big push, especially in America, to siphon off the money of the public into semi-government arms, sometimes actual arms of the government, sometimes actually tax collectors, sometimes just private companies that are using a lot of marketing to put you at risk. The healthcare infrastructure, the way that cars work, the way that home lenders work, have a tendency to work arm in arm with insurance companies to get far more money from you in the long run, to make the cost of things much higher than you realize. And there are so many big businesses and government that benefit from this. And it doesn't require some conspiracy. That's always what people jump to. It is simply the nature of uncontrolled financial gain, right? There's no monitoring on this. It is discouraged to stand up and say, you know, you're getting scammed, right? Insurance is a scam. Like, you should be aware of this. It's frowned upon to point out that if the government hires a private company to collect money by force, that's tax collection. Like, none of these things are things that America once said, and it's very poo-pooed. And in other countries, some of this is obvious and some of it's exactly the same, right? So it's not a US thing, but there's so much push that insurance sounds so good. And it's just like bonds, right? Everyone says bonds are conservative. No, they're reckless financial instruments for those who are being tricked, generally by a government. Not necessarily, but generally. The government says, oh, and the idea is that you're lending government money to the government because you want the government to succeed. It is not because you're supposed to be making money. It just keeps you from having a huge loss. But it's not conservative. It is reckless from a financial perspective. If it's a political thing, which is what it's supposed to be, then it's not so reckless as long as it meets your personal political agenda. So in all these things, it's good to step back and say, is the public really right? Is insurance something I shouldn't even calculate? I should just get insurance. I should just trust big business to have my interest. As soon as you say it, you say, oh my gosh, huge financial decisions in my life should be done with math and by comparing against alternative options with my money. And I should use logic and math. I should not trust other people who I know are not using logic and math. And I should not listen to the marketing. Big business is pushing these things on me through marketing. That should make me wary of them. When someone's pushing the latest color of Crayola crayons on you through marketing, that's just, do you want this color? Come pay for it. But when they're pushing things that completely affect your lives, your ability to have a house, your ability to stay alive, your ability to travel, you should really question letting marketing drive your decisions through emotions rather than math. Basically, if it feels like you should have insurance, but the math says no, you know your answer. Nothing financial in your life should be driven through your feelings. There should be solid financial decision-making made against reasonable baselines, and really look at how the things work before you commit outrageously large financial resources to something you are almost certainly never going to come close to recouping. Thanks for joining me. Please remember to like and subscribe. Ask your questions below. This is a big topic. We cover finance here sometimes. This is something that I think is really important and people need to understand. And a lot of people have questions about insurance in other countries. Well, what do I do for insurance when I travel? That kind of plays into this. And a lot of people, I do a lot of consulting with business, and they want to know, what should we do for business insurance? And it often plays into what I do. So these are topics that cover a lot of my viewers in a lot of different situations. If you want to support the channel, you can buy me a coffee, share on social media, tell your friends about the show, link wherever you can. I will see all of you tomorrow.